Welcome to Explain the Charts, where today we are conducting a deep dive analysis into the USDJPY currency pair on this Monday, March 23, 2026. The market is currently abuzz with the fallout from the central bank doubleheader we witnessed last week, featuring both the Federal Reserve and the Bank of Japan. Headline news confirms that the interest rate differential remains the primary driver here, with the Fed holding firm at 3.50 to 3.75%, while the BOJ sits at a mere 0.75%. This 275 basis point gap continues to incentivize the carry trade, keeping the US dollar fundamentally supported against the struggling yen. Recent reports from FX Street and Bloomberg suggest that while the yen saw brief strength earlier in the month, intervention risks from the Japanese Ministry of Finance are now looming as we approach the 160 level. Specifically, TD Securities strategists have warned that JPY intervention risks are elevated because we are trading near the 2024 highs that previously triggered market defense operations. Looking at the broader economic landscape, Japan's core inflation data for February is a key metric that traders are watching to see if the BOJ will be forced to accelerate its normalization process. On the other side of the Pacific, the US dollar index has shown resilience as Treasury yields jumped following the Fed's hawkish hold on rates. Analysts from Trading News indicate a bullish long-term target of 163.21 within a month, provided the Fed does not signal any cuts for the remainder of 2026. However, there is a clear divide in the market, with some technical signals suggesting Wave 3 impulses to the upside, while others warn of an overextended rally. The energy crisis in Japan, where virtually all energy needs are imported, adds another layer of fundamental bearishness for the yen as it weakens the trade balance. We are also seeing correlations between traditional Forex markets and crypto, as Bitcoin often hits post-FOMC troughs just as USDJPY finds its footing. Traders Union has noted that the current buying pressure is targeting resistance near the 160 yen mark, driven by strong technical momentum and the swap differential. If the BOJ remains slow to hike rates, the fundamental path of least resistance for USDJPY remains upward, despite the constant threat of a sudden sell-off. Today, we will analyze whether the current price action supports a breakout or if the intervention shadow will force a deep correction back to the 157 range. Transitioning to the daily chart, we can see the spectacular climb that has defined the last several months of USDJPY price action. The pair recently touched a yearly high on March 18th near the 159.80 zone, stopping just short of the critical 160 barrier. Looking back at early February 2026, the pair was trading much lower around 151.16, marking a gain of over 5% in just 6 weeks. On the daily time frame, the series of higher highs and higher lows is undeniable, suggesting a strong bullish trend is firmly in place. We saw a significant dip on March 3rd where the price hit a low of 149.09, but it was quickly bought up, showing the strength of the underlying demand. The most interesting feature of this daily chart is the 20-day EMA, which has acted as a dynamic floor during recent pullbacks. Every time the price has retreated, it found support near the 157.50 level, which aligns perfectly with recent technical forecasts. On March 19th, we saw a long red candle where the price fell from an open of 159.80 to a low of 157.45, yet it closed the next day back above 159. This indicates that the market is aggressively absorbing any selling pressure that enters the arena below 158. Resistance is now clearly defined at the 159.80 to 160.23 zone, which is what analysts call the intervention risk zone. If the daily candle closes convincingly above 160.74, it would signal the highest exchange rate since 1990, potentially rewriting currency history. Short-term pullbacks toward the 158.00 level have been identified as prime by the dip, opportunities for those following the trend. However, if the price manages to settle below 155.17, the bullish structure would be seriously compromised on the daily time frame. Currently, the volume remains consistent with a trending market, though we see spikes during the US-Japan overlap sessions. The daily RSI is hovering in overbought territory, which warns of a potential pause before the next major leg up. Let's narrow our focus to the 1-hour chart to observe the volatility surrounding the March 18th Federal Reserve meeting. As we can see, the hours leading up to the announcement saw the pair climbing steadily from 158.90 toward the 159.90 level. The initial reaction to the Fed's hawkish tone was a surge in the dollar, but that was followed by a sharp hourly reversal as profit-taking ensued. Specifically, between 1700 hours and 1900 hours Universal Time Coordinated on March 19th, we saw a dramatic drop from 159.80 down to 157.53, a move of nearly 230 pips in a few hours. This flash drop is characteristic of the yen market when intervention rumors start to circulate or when large-scale stops are hit. Notice how the price found immediate support at the 157.45 hourly low and began a multi-hour recovery that reclaimed most of the losses. By March 20th at 1400 hours Universal Time Coordinated, the price had climbed back to 159.13, showing the incredible resilience of the USD bulls. The hourly structure now shows a consolidation pattern between 159.10 and 159.45 as the market awaits fresh catalysts on this Monday morning. A key price level to watch on this chart is 158.70. Staying above this suggests the bullish momentum is intact for a retest of 160. If we see an hourly candle close below 158.30, it could trigger a deeper secondary test of the 157.50 support zone. The Fibonacci retracement from the March low to the recent high shows the 0.236 level, providing short-term stability for the current consolidation. Volume on these hourly candles shows significant participation during the rebound, reinforcing the idea that buyers are still in control. The hourly RSI failed to make a new high alongside price during the recovery, creating a slight bearish divergence to keep an eye on. This suggests that while the price is high, the momentum behind the most recent push might be thinning out. Watch for a breakout of this narrow hourly range to determine the direction for the rest of the New York session today. Switching down to the 15-minute chart, we can see the micro-movements occurring over the last 24 hours, including the Sunday market open. The pair opened the week slightly higher at 159.45 and has been drifting in a very tight 30-pip range since then. Intraday support has formed around 159.10, which we saw the price test multiple times during the Asia-Pacific session. On the upside, minor resistance at 159.47 has prevented any meaningful progress toward the 160 handle so far today. This sideways price action is typical of a market that is digesting the massive volatility from the previous week's central bank meetings. For scalpers, the 159.15 to 159.35 range is providing small opportunities, but the lack of trend on this time frame suggests waiting for a breakout. We can see a small bearish wedge forming on the 15-minute view, which could lead to a quick test of 158.90 if it breaks to the downside. Conversely, if the price pierces 159.50 with a volume spike, we could see an accelerated move toward 159.80 fairly quickly. The VWAP on the 15-minute chart is currently sitting at 159.23, and the price is oscillating right around this average. This confirms that the market is in a state of short-term equilibrium as traders weigh the hawkish Fed against intervention fears. Keep an eye on the transactions count. A sudden spike in activity at these levels usually precedes a directional break. The candle at 22:01 Universal Time Coordinated on March 22nd showed an initial pop at the open that has since been moderated by consistent yen buying. Notice the long wicks on the candles near 159.10, indicating that buy orders are stacked at that level to prevent further slippage. Short-term traders should look for a 15-minute close outside of this range to confirm the next leg of the intraday trend. If 159.10 holds, the bias remains slightly bullish for the European session open. To recap our analysis for USDJPY on this 23rd of March, 2026, the primary trend remains bullish on almost all higher timeframes. Key price levels to memorize are 157.50 as major support, 159.10 as immediate support, and 159.80 to 160.00 as the primary resistance ceiling. Our unbiased prediction is that the pair will likely attempt to test the 160.00 level again within the next 48 to 72 hours. I place the likelihood of a 160.00 test at 70%, given the current interest rate differential and the resilience shown on the recovery from 157.45. Conditions that would reinforce this bullishness include any further hawkish rhetoric from Fed officials or a delay in Japan's core inflation reporting. However, the likelihood of a successful breakout above 160.50 without triggering a Bank of Japan intervention is significantly lower, perhaps around 30%. If an intervention does occur, we should expect a rapid and violent reversal that could send the pair back toward the 155.00 or 153.00 levels in a matter of days. Things to look for include any rate check rumors by the BOJ or a sudden decline in U.S. Treasury yields, which would narrow the carry trade incentive. In the long term, if the BOJ cannot normalize rates above 1% by mid-2026, targets of 163 to 165 remain fundamentally plausible. Short-term traders should watch the 159.10 support very closely. A break below this would signal a temporary top is in place. Be wary of high volatility spikes during the London and New York overlaps, as that is when intervention is most likely to be effective. Look for the RSI on the daily chart to cool down through consolidation before expecting the next major impulsive move upward. If you are trading long, trailing your stops to just below the 157.40 low seems like a prudent risk management strategy. If you are looking to short, wait for a confirmed rejection of the 160 level with a strong bearish engulfing candle on the hourly time frame. The USDJPY pair remains one of the most volatile and news-sensitive assets in the Forex market right now. We will continue to monitor the one-day candles to see if a sustained close above 160 is achieved this week. This confluence of fundamental divergence and technical resistance makes for an incredibly high-stakes environment for all currency traders. Make sure to keep your position sizing disciplined, as the intervention risk zone is not a place for reckless leverage. Thank you for watching Explain the Charts, and I hope this data-driven analysis helps you navigate the USDJPY markets today. Stay tuned for our next update as we track the potential historic breakout or reversal at the 160 yen mark. Please remember that this video and script are for educational and informational purposes only and do not constitute financial advice. Trading Forex carries a high level of risk and may not be suitable for all investors. Always perform your own thorough research and consult with a qualified financial advisor before making any investment decisions. Market conditions can change rapidly, and past performance is never a guarantee of future results. Trade responsibly and always protect your capital.